Every second, America's debt climbs by $192,000. In 2024, the U.S. shattered the $35 trillion mark, and the surge isn't slowing. This isn't just another crisis. It's a breaking point that no government plan can reverse. Behind the numbers lies an eroding trust, a nation trapped between collapse and denial. If the world's reserve currency spirals, who pays the price? Here's how it happened. In 1945, the U.S. emerged from World War II with a towering debt but a booming economy. Factories shifted from tanks to cars, highways stretched across the continent, and millions of veterans bought homes with new government-backed loans. With the world rebuilding, American exports soared. As a result, the federal debt-to-GDP ratio, once over 110% at the war's end, steadily dropped for decades. By 1960, it had fallen below 55%. Growth outpaced borrowing, and the nation's balance sheet seemed unbreakable. But the pattern didn't last. By the 1980s, a new era began. Ronald Reagan entered office promising to cut taxes and boost defense spending. Congress approved sweeping tax reductions in 1981, slicing the top income tax rate from 70 to 50%. Government revenues shrank, but spending kept climbing. The Cold War arms race drove defense budgets higher, while social programs expanded. Annual deficits ballooned. Between 1980 and 1989, the federal debt more than tripled, rising from $908 billion to $2.8 trillion. The debt-to-GDP ratio, after decades of decline, began to rise again. Economists like Kenneth Rogoff warned that when debt levels approach a country's annual economic output, the risks compound. The United States, once a model of fiscal discipline, now faced a widening gap between what it promised and what it could afford. The first cracks in the post-war consensus were visible, a warning that future crises would not be solved with growth alone. In September 2008, Wall Street's collapse triggered a financial panic that spread across the globe. Within weeks, Congress authorized $700 billion for bank bailouts, followed by trillions more in emergency lending and stimulus. The rescue worked, but it rewrote the government's crisis playbook. Borrowing at scale became the default response, not the exception. In the decade that followed, deficit spending never fully retreated. The debt, which stood at $10 trillion in 2008, doubled again by 2016. But the real explosion arrived with the COVID-19 pandemic. As businesses shuttered and unemployment soared, Congress approved more than $5 trillion in emergency outlays between 2020 and 2022. Direct payments, expanded jobless benefits, and business loans flooded the economy. For the first time, the federal deficit topped $3 trillion in a single year. Debt soared past $30 trillion. The surge in spending, combined with supply chain shocks, fueled the highest inflation in 40 years. Prices rose faster than wages, and the Federal Reserve responded by raising interest rates at a pace not seen since the 1980s. The government, now carrying a mountain of short-term debt, faced a new problem. Every uptick in rates made future borrowing vastly more expensive. The era of ultra-cheap money was over. America's debt curve, once a slow incline, had become a vertical climb. Interest on the national debt has become the government's largest single bill. In 1990, net interest payments stood at just $200 billion a year. By 2025, that figure has soared past $1.2 trillion. More than the entire annual defense budget, which itself is about $852 billion. The Congressional Budget Office projects that interest will swallow nearly 17% of all federal spending this year, a share that's never been higher. Every dollar spent on interest is a dollar that can't fund roads, research, or safety nets. The mechanics are relentless. As old debt matures, the Treasury must refinance at today's higher yields. In 2021, the government could borrow at an average rate of 1.6%. Now, new bonds are issued at more than double that, with 10-year yields above 4%. Nearly $8 trillion in marketable debt will roll over in the next 12 months alone, locking in these higher costs for years to come. Olivier Blanchard, former chief economist at the IMF, describes the danger as a loop. Higher rates drive up deficits, forcing more borrowing, which in turn pressures rates higher still. He warns, The interest deficit loop threatens to compound, crowding out spending on growth and safety nets. At scale, fiscal space disappears quickly. This is not just a line item in the budget. It's a compounding burden that grows with every uptick in rates, every new bond auction, every year that deficits persist. The interest bill has become a shadow budget, siphoning resources before a single school is funded or a soldier is paid. The numbers are no longer abstract. They are the price of past choices, coming due in real time. Every new Treasury auction now sets off a chain reaction. As the government borrows more to cover its bills, it must offer higher yields to entice buyers. The result is a self-reinforcing cycle. Each uptick in borrowing drives yields higher, and each increase in yields makes the next round of borrowing even more expensive. In 2025, the Treasury faces nearly $8 trillion in debt maturing over the next year. Each time old debt comes due, it is replaced with new bonds at today's rates, often above 4% for 10-year notes and even higher for 30-year bonds. This is no longer just about the amount borrowed, but the terms demanded by the market. Primary dealers and institutional investors now demand a premium, wary of absorbing so much supply at once. When demand wavers, auctions clear only after the Treasury accepts steeper rates, sometimes several tenths of a percentage point above expectations. These small increments compound quickly across trillions in issuance. For every 100 basis point jump in average yield, annual interest costs rise by more than $270 billion over 5 years, according to Congressional Budget Office models. Even modest surprises in auction results ripple through the entire curve, raising costs for future borrowing and for everyone who relies on Treasury rates as a benchmark. The feedback loop is automatic. Higher yields mean higher deficits, which require more borrowing, which in turn puts further upward pressure on yields. There is no pause between these steps. Weekly auctions, monthly rollovers, and persistent deficits keep the cycle spinning. What began as a manageable cost has become a compounding spiral, dictated not by policy, but by the cold logic of the market. The interest bill grows not just with each new law passed in Washington, but with every tick upward in the global appetite for risk. The scale of the auctions themselves now shapes the price the government pays, and the price is rising. Every year, the same drama unfolds on Capitol Hill. The Treasury Secretary warns Congress that the government has hit its legal borrowing limit. Headlines blare about an approaching X date, the moment when cash runs out. Lawmakers take their places in a well-rehearsed standoff, trading accusations on cable news while staffers calculate how long extraordinary measures can keep payments flowing. These measures, suspending investments in federal employee pension funds, redeeming securities early, by only a few weeks, sometimes a couple of months. The clock keeps ticking. Since 1940, Congress has raised the debt ceiling nearly 90 times. In the last decade alone, near-annual confrontations have sparked market tremors and brought the government to the brink of default. The 2011 standoff ended with the Budget Control Act, passing the Senate 74-26 and the House 269-161, but not before Standard & Poor's downgraded America's credit rating for the first time. In 2013, the government shut down for 16 days. The 2023 crisis saw the Treasury operate for months using accounting maneuvers before a last-minute deal capped spending, but left core programs untouched. In July 2025, another showdown forced a $5 trillion ceiling increase, with phased cuts and side deals packed into a single sprawling bill. Each episode follows the same script. Party leaders threaten collapse, factions within both parties refuse compromise, and late-night negotiations produce deals heavy on headlines but light on real restraint. The refrain echoes through every chamber. Washington argues about the ceiling, but nobody's fixing the floor. As Maya McGuinness has warned, the resistance isn't just political, it's built into the structure itself. Constituency groups and donors mobilize to block even modest reforms, ensuring that the cycle repeats, crisis after crisis. Lobbyists swarm Capitol Hill year-round, shaping every budget negotiation from the shadows. In 2022 alone, healthcare, defense, and senior benefits groups spent more than $400 million lobbying against long-term spending caps. Their influence isn't subtle. Industry representatives fill committee hearings, draft amendments behind closed doors, and hold private corridor meetings with key lawmakers. When Congress debates broad cuts, these groups mobilize instantly, flooding offices with calls, campaign donations, and threats to fund primary challengers. The result is a budget process where carve-outs for defense and Medicare appear in bill after bill, while real consolidation efforts stall. The structure of Congress rewards this kind of resistance. Party leaders face not only the opposing side, but also hardline factions within their own ranks. The House Freedom Caucus, for example, can block legislation by withholding just a handful of votes, forcing leaders to water down reforms or tack on side deals. Meanwhile, appropriators and committee chairs defend their own turf, unwilling to sacrifice funding for favored programs. Even modest attempts at procedural reform like automatic continuing resolutions or priority rules for debt service have repeatedly failed, blocked by lawmakers who fear losing leverage or angering donors. Maya McGuineas, who leads the Committee for a Responsible Federal Budget, calls this a built-in resistance. Every constituency group and donor network is primed to block the pain of consolidation. The result is a credibility gap. Washington cannot promise restraint when every interest group is armed for battle. As the debt grows, so does the gap between what lawmakers say in public and what the structure of power actually allows them to do. Foreign demand for U.S. Treasuries is quietly slipping away. Since early 2022, overseas holders have trimmed more than $300 billion from their Treasury portfolios. China, once America's largest creditor, has reduced its exposure by over $340 billion, dropping below $760 billion in holdings by mid-2025. Japan, too, has pulled back, cutting its stake by nearly $200 billion over the same period. The official U.S. Treasury tick data now shows total foreign ownership at roughly $7.5 trillion. A sizable sum, but a clear retreat from the $7.8 trillion peak just 2 years ago. This shift is not just about numbers on a spreadsheet. It reflects deeper unease in global capitals about the reliability of U.S. fiscal policy. According to Eswar Prasad, former head of the IMF's China division, Chinese policymakers have spent years quietly shortening the maturity of their U.S. bond portfolios and redirecting reserves toward gold and other currencies. The goal is simple: reduce exposure to what they now see as a growing risk. Prasad notes, China's shift out of treasuries is, for now, gradual, but it reflects a regime-level perception of long-term unreliability in U.S. debt policy. The dollar's share of global reserves has also slipped. IMF COFR data puts it at 58.2% in mid-2025, down from 65% in 2016 and well below the levels seen at the turn of the century. That decline has not brought a sudden collapse. No other currency yet matches the dollar's depth or liquidity, but the direction is clear. Central banks from Riyadh to Zurich are quietly diversifying, adding euros, yen, and even yuan to their vaults. In March 2023, Brazil and China completed their first direct trade settlement in yuan and reais, bypassing the dollar entirely. The deal covered just over $150 million in goods, a drop in the bucket for global trade, but a symbol of intent. Other BRICS nations have announced similar plans, seeking to build payment systems that do not depend on the U.S. financial network. While these efforts remain small, they signal a world where dollar dominance can no longer be taken for granted. The erosion of these external backstops has consequences. When foreign buyers step back, the Treasury must find new sources of demand, often at higher yields. The U.S. still enjoys the privilege of issuing the world's reserve currency, but that privilege now comes with a warning. Confidence is not a given. When trust in America's fiscal path wavers, even the deepest markets can feel the strain. The numbers are no longer negotiable. When the Office of Financial Research ran its latest stress scenario, the result was a warning. A sudden spike in Treasury yields could wipe $1.5 trillion from the market value of U.S. government debt. That loss would not stay on paper. It would ripple through banks, pension funds, and central banks around the world, forcing sales and freezing liquidity in what is supposed to be the world's safest market. The scenario assumes a 250 basis point jump in yields, less than what hit the UK gilt market in 2022, but enough to trigger forced selling and margin calls across the financial system. The losses would land everywhere at once, from New York to Tokyo, from insurance portfolios to state retirement accounts. The government faces three doors, each with a heavy price. The first is sharp austerity, deep, immediate spending cuts and benefit reforms. That option risks recession, surging unemployment, and political backlash. The second is large, broad-based tax increases. But raising taxes at this scale would sap demand, slow investment, and could even spark stagflation. The third is financial repression, holding down rates by force, pressuring banks to buy government bonds, or stoking inflation to erode the debt. This path quietly drains savers and investors, undermining trust in the dollar itself. Every credible analysis, from the CBO to the IMF, agrees there is no painless way out. Stabilizing the debt now requires choices that will hurt, no matter which path is chosen. The scale of adjustment needed is historic. Even a blend of all three options would mean years of slower growth, higher taxes, or diminished purchasing power. The $1.5 trillion stress test loss is not a worst-case fantasy. It is a plausible outcome if markets lose faith in Washington's ability to act. The math is not theoretical. It is a hard limit, enforced by the world's investors, not by Congress. There is no off-ramp that avoids pain. The only question left is who bears the cost, and how soon. In July 2024, U.S. national debt crossed $35 trillion, rising by over $1 trillion in just 71 days. Over decades, each crisis brought new borrowing, from Reagan-era deficits to $5 trillion in pandemic aid to today's record-high interest costs. By 2025, annual interest payments are projected to exceed $1.1 trillion, more than the entire defense budget. Despite repeated promises, Congress remains locked in near-annual debt ceiling confrontations, while over $400 million in lobbying reinforces the status quo. Globally, foreign holders have cut $300 billion from U.S. Treasury holdings since 2022, and the dollar's share of global reserves has dropped to 58%. Yet much remains unknown. How global markets will ultimately respond, or at what point confidence in U.S. fiscal policy may break. The evidence shows there is no painless fix. The choices are higher taxes, lower spending, or inflation. America's $35 trillion debt is no longer just a number. It is a limit that shapes the future for the U.S. and the world.